Welcome, future mortgage professionals. Look, if you're ready to absolutely crush your licensing exam and get your career started, then you are in the perfect spot. We are about to break down the must-know essentials that will get you that passing score.
So, what's our game plan? Simple. We're going to kick things off with a real-world client problem. Then, we'll dive deep into mortgage mechanics. After that, we are opening the terminology vault for the words you gotta know. We'll expose a classic exam trap, and then we'll finish with a rapid-fire final countdown to make sure it all sticks. Let's do this. You know, being a great mortgage loan originator isn't just about memorizing a textbook. It's about using what you know to solve actual problems for actual people. It's all about putting that theory into practice.
Okay, so picture this. A couple walks into your office. They have solid jobs, fantastic credit, but they've only saved up a 5% down payment. This is a situation you will see over and over and over again. And that small down payment, that's the puzzle you have to solve. The answer is all about understanding the two basic mortgage food groups.
All right, let's get into the mechanics. The entire mortgage universe, and I mean all of it, is basically split into these two major categories. You absolutely have to master this difference. It's non-negotiable for the exam.
The huge difference between these two worlds, it all comes down to one thing: government backing. That's it. See, on the left, conventional loans are just a private deal. It's between a lender like a bank and a borrower. But on the right, non-conventional loans, like FHA and VA, they have the government's seal of approval. And that one little fact changes absolutely everything. Exam alert. Okay, listen up. For conventional loans, lenders live and die by a couple of key ratios. The first one is the housing expense ratio. They want a borrower's total housing payment, we're talking principal, interest, taxes, and insurance, to be no more than 28% of their gross monthly income. You need to burn that number into your brain. Exam alert? And here's the other magic number. Lenders also look at the total debt-to-income ratio. This is the housing payment plus all their other monthly bills. You know, car payments, credit cards, student loans. Ideally, for a conventional loan, this number needs to be 36% or less. This 28-36 rule, it's the bedrock of conventional lending.
All right, if you want to pass this exam and sound like a true pro with clients, you have to speak the language. So let's crack open the terminology vault and master 4 terms you will see on the test and use every single day. I want you to think of LTV as the lender's risk meter. It's really simple. You just take the loan amount and divide it by the home's value. So for a couple of that 5% down payment, they're borrowing 95% of the home's value. That means they have a 95% LTV. And the higher that LTV, the more the lender's risk meter starts beeping.
So what happens when that risk meter goes into the red zone? Well, that's where PMI, or private mortgage insurance, comes into play. On a conventional loan, anytime a borrower puts down less than 20%, that LTV shoots above 80%, and the lender is going to require this insurance policy. But here's the crucial thing to remember. PMI protects the lender, not the borrower. This is exactly what our clients with that 95% LTV are looking at.
This is pretty much the standard issue loan you'll be dealing with most of the time. In a fully amortized loan, every single monthly payment is doing 2 jobs. It's paying off some interest, and it's chipping away at the principal. At the beginning, it's mostly interest, but slowly, over time, more and more of your payment goes to knocking down that loan balance, until, poof, it's gone.
Now, an ARM is a totally different beast than your stable, predictable fixed-rate loan. It might start out with this really attractive, low teaser rate for a few years. But after that period is up, the rate can adjust based on the market. That means the borrower's payment could go up or down. It adds a whole level of uncertainty you have to be really clear about with your clients.
Okay, let me let you in on a little secret. The state exam loves to use tricky wording to see if you're really paying attention. They want to know if you can spot those tiny but critical differences in the terminology. Let's look at a classic trap.
This question gets people all the time. I mean, the logic kind of makes sense, right? A jumbo loan is for a huge amount of money, so it's not really standard. So that must mean it's non-conventional. Yeah? What do you think?
Exam alert. And here's the answer. No. A jumbo loan is a conventional loan. Why? Because there's no government backing. Simple as that. Here's the trick. It's a non-conforming conventional loan because its size is bigger than the limit set by Fannie Mae and Freddie Mac. This is so important. Non-conventional means government-backed. Non-conforming just refers to the loan size or other rules. Do not get those two mixed up on your test.
All right, fantastic job. Let's bring it home with our final drill. we're going to lock in the 3 most important things we covered today. This is your rapid-fire recap for Test A. Ready?
Let's burn this into your memory. Number 1. The big split, conventional versus non-conventional, it's all about government backing. Got it? Good. Number 2. The magic numbers for conventional loans are 28 and 36. Just remember 28, 36. And number 3, the trigger. An LTV over 80% on a conventional loan is what triggers PMI. These are guaranteed points on your exam.
So let's circle all the way back to that couple. Now, with these tools, you can actually guide them. You can explain that a conventional loan is an option, but because of their 95% LTV, they'll have to pay for PMI. Or maybe you explore a non-conventional FHA loan, which only requires a 3.5% minimum down payment. See the difference? That's the power of knowing your stuff. You're not just processing a loan, you're a trusted advisor. Keep studying like this and you are going to pass.